Good morning, everyone, and thank you for taking the time to join us today for this first fixed income update of 2022. I'm wishing you all a very prosperous 2022. I'm Darby Carstens from Prescient's Retail Business Development Team, and I'll be hosting you from our office here in Stellenbosch. I'm joined today by the two other gentlemen in the video feed sitting in our recording studio out in Westlake, Cape Town. Henk Kotze heads up our income and cash teams, and Reza Ismail is head of our bonds team. I think both of them are quite eager to talk to everyone today. Both our Income Provider Fund and Flexible Bond Fund had some very good performance numbers for 2021. And if I'm not mistaken, I think the Flexible Bond Fund was the #1 performing fund in South Africa in the bond space. But we're not just here to talk about performance numbers. The uncertainty around US inflation and the urgency and magnitude of the Fed's response emphasizes the importance of established risk as we've employed an income provider for the past 17 years. And also the valuable attributes of a flexible bond process where duration calls are based on deep research and implemented quickly and efficiently. Spare me one last minute to quickly run through our agenda. Reza will take us through the global macro views and what we think is driving the markets, followed by Henk. We'll look at the local side, give us a quick performance overview and update on income provider. Reza will then finish off on the bond side with the performance and current positioning of our flexible bond fund. If you have any questions, please post them in the Q&A function on Zoom, and we'll answer them at the end of the webinar. We'll also be running a couple of polls throughout the webinar, so take the 1 second it takes to answer the question. It's quite insightful information we get from that. Perhaps, Reza, before you kick off, one quick question. We often get asked about duration within our income portfolios, but very seldom do clients ask us about term. Could you quickly just differentiate between those two risks in the income space? Thanks.
Thanks, and good morning, everybody, and always a pleasure to join you in this forum. And just to kick off with that question directly, so duration and term are sort of two related concepts, and they sort of convey the same idea, right? And that idea is that the greater the term of your investment in general, the more you are exposed to interest rate risk, right? And that is the key idea. Now, why I say they are related and not the same concept is because, for example, you may have a 20-year bond, right? So its term is 20 years, but you may find it has a duration of only 8 or 9 years. Now, duration is defined technically, but simply it means that if an instrument has a duration of, let's say, 8 years, it means that its sensitivity to the change in yield is around sort of 8%. So, for example, if a bond has a duration of 8 and yields compress by 1%, it means you get a price gain of 8%. So in general, the bond funds are able to take greater latitude with regards to duration. They are able to invest in long-term instruments, which have a duration of, let's say, between 8 and 10. So every yield move gives it a 10%, 8% to 10% price reaction. In contradistinction, the income funds, obviously, because they need, they've got imperatives that relate to capital preservation and minimizing of the volatility and sort of like a less bumpier ride, typically don't have as much duration or term latitude. So typically you would find that, Henk can elaborate on this, but typically they would cap their duration at around 2 years. So it means that if the kind of instruments they invest in, if there's a change in yield, if yields sell off by 1%, you only get a 2% price reaction. And that's a kind of signature that you generally want to have in a fund that has got a strong capital preservation bias. And I think that's the key ideas.
Just maybe as a side on the term, where as it relates to credit, the term risk of a credit instrument, you could have a 10-year credit exposure. So for, as Reza said, your risk to that instrument is for 10 years, but your interest rate exposure could only be a quarter of the year if it's a quarterly or floating rate instrument. So there again, your term is quite important because you're exposed to the credit risk or the spread risk, as opposed to just the interest rate on those instruments. So just another point to be made on the term side. Cool.
Cool. If that is sufficient, and then I think we can sort of kick off. And as Davi mentioned right at the beginning, the agenda broadly will be sort of the global macro side of things, which I will cover. Then we will have Henk that will go into the local macro scene and dive straight after that into the income provider fund specifics. And I will come back at the end for portfolio specifics with regards to our flexible bond fund, right? So, without further ado, let's get started. And essentially, I mean, those that were here, part of the audience at the last webinar will know that we generally like to just state at the beginning the general outline of the kind of arguments that we'll be making, more or less like a storyboard that that serves as a golden thread, summarizing our key contention. So let's go. The first one, as we mentioned last time and hasn't changed, is that we continue to believe that emerging market yields and currencies have pricing determinants that are almost exclusively global in nature, right? So what really matters for price setting in emerging markets are factors that are almost exclusively global in nature, right? Second one, last year you would remember, and you probably read this ad nauseum in the financial press, but the preoccupation with how to characterize U.S. inflation, was top of mind, and the core PCE variant thereof, and that was really for two reasons. And what are those two reasons? Well, the first one was that, in other words, why was there this preoccupation? The first one is that not all Fed hikes are created equal, right? So depending on the kind of inflation, and the characterization of inflation that was in force, a Fed hike in response to that could have very different consequences. For example, if it were the case that we were dealing with the US moving to a completely new inflation regime, and the Fed hiked rates in that context, history has shown that is very destabilizing for the global economy. However, it was not actually the case that we were working with a completely new inflation regime as such. It was always the Fed's contention, and it was our contention as well. Yes, inflation prints have been very conspicuous and very high, but they didn't herald a move to a new inflation regime as such. There won't be time for me to deep dive into that like last time, but suffice it to say, despite elevated and extended inflation prints, the US is not moving to a new inflation regime. The second reason why there was this preoccupation with inflation was because there was a possibility that with heightened inflation prints, that it would actually unhinge and de-anchor long-term inflation expectations, and that is a very consequential dynamic if it came to pass, right? Because it could basically affect the credibility of the central bank as such, right? However, there was no evidence for that as well. There was no evidence that despite inflation prints, of the order of around 7%, long-term inflation expectations remain very well anchored, sort of around 2%, which is where the Fed wants inflation, through the cycle, right? Number three, talking about the labor market, the recoveries in developed world labor markets are very complex and require quite granular analyses. In the US, for example, central measures of unemployment and wage growth would optically just point to an economy that was overheating, right? Just if we just look at the raw unemployment numbers and wage growth. However, I mean, these attributes of the labor market need to be counterbalanced by two other factors, and that is still a very subdued labor participation rate in aggregate, sitting at the early 60s, and very noteworthy gains in productivity. What this means is that taken together, if we exclude the kind of irregularities that we have on the current irregularities on the demand and the supply side in the US, if we exclude that and we look only at the labor market, one might be tempted to say the tightness of the labor market will certainly translate to inflation impulses, translating higher. However, that's actually not the case, right? So what we do know is that if you have wage growth, but you have productivity gains in excess of that, right? You will not have an inflationary impulse. And that is one of the main contentions that we want to show. And I have one or two slides on that. So, it's quite hard, but putting aside all of the idiosyncratic stuff about, heightened demand and a supply side that is unable to react, if we shove that aside for a second and look at the normal starting place for inflation, which is the labor market, we find that there's been quite seismic changes in the composition of the US labor market, which means that you might not have realized inflation for an otherwise very tight labor market. Number 7 basically says that, I mean, if we look at both of my concerns in 2A and 2B, they essentially relate an inflationary outcome to a change ultimately in financial conditions. And what I'm here to say today is that the evolution of financial conditions globally is arguably the dominant theme for 2022. Number 9, we have no doubt that financial conditions led primarily by monetary policy action in the US will lead to financial conditions tightening in 2022. However, the correct framing of the question should say, is the quantum of this tightening sufficient to derail the case for risk assets? And that is really the question we need to ask. Our preliminary econometric evidence suggests that there are very significant changes that need to be made to the US federal funds rate. That means rate hikes in excess of expectations and in long-term US bond yield before financial conditions meaningfully tighten. So there will be a tightening, but our preliminary contention is that it won't tighten to an extent that essentially derails the case for risk, meaning that it won't tighten to an extent that derails the case for the kind of assets like South African bonds, South African currencies, and the like. So that is the general outline of how we're going to argue. So I just want to go a little bit into, for example, a couple of the points that I made. So let's look at labor markets, right? For example, if we could maybe just minimize that. Apologies to our viewers, but yeah. So essentially, what we're showing here is the total change in hours worked in the US and in the Euro area juxtaposed, next to each other, and we can see that there's a very different composition if we look at the US. If we look at the delta in the total hours worked, we saw that it decreases around between 14 and 16%, but most of that comes about because of a change in employment, which means that the hours are decreasing because people are either becoming unemployed or because they are no longer part of the labor force. In Europe, in distinction to that, total number of hours goes down more or less to the same quantum, call it 16%, but it's not because people are becoming unemployed or people are leaving the labor force. It's mainly because the average number of hours per worker, has taken a major dive downwards. So people are still being kept on by companies, but for less hours. Why is that consequential? I'll come back to that in just a second, just to show you again, if we were to look at labor participation in the US, one of the reasons, that, they sort of leave, the total number of hours goes down. I said if labor participation decreases. Now, why is the reason? The first one is fiscal support. So people were not keen to look for jobs. They were keen to sit at home and collect stimulus checks, right? That has now abated, but people do still have a fair degree of pent-up savings. Second one is the absence of retention schemes. So what does that mean? It means that unlike Europe, in the US, older workers were generally culled from the workforce. They were given early retirement packages, or their jobs were made redundant simply because for older workers, it's incredibly hard to sort of upskill them. So what we actually find is that this is pointing to a US labor market that has changed in composition somewhat radically, in the sense that sort of non-productive elements of the labor market have been shipped out. So unemployment is low, labor participation is low, but the US is actually moving towards a more productive economy. So even if you do have wage growth, as I said in the beginning, doesn't necessarily have inflation implications, okay? A couple of other pieces of evidence to corroborate that. This is what is known as sort of the Beverage Curve. And what it relates to is it relates an unemployment rate to the number of job vacancies. Now, normally, if we just look at the period sort of from August 2000 to 2008, and even after that, we see that for a given unemployment rate, there's almost like a set amount of job vacancies. However, what has happened of late from March 2020 is that the Beverage Curve has moved outwards. And what that generally indicates from classical economics is that for a given rate of unemployment, for a given level of tightness in the market, there's actually still quite a lot of unfilled jobs. There's still quite a lot of job vacancies. Now, why do you have that? You have that if there's a skills mismatch between the spec that the job is looking for and the general pool of available workers, meaning that it's not so much that there's a lot of unemployed people in the US, but it's that they simply don't want to apply for jobs. They've become discouraged because they don't meet the skill set of the new kinds of jobs that are opening up that require high productivity. Incidentally, you don't see the same picture in Europe, right? So quickly before I wrap up, I mean, I just want to show you that. So I'm almost trying to make the case that there's that there's bigger productivity on the cards on the horizon in the US. And is there some evidence for that? Yes, there is. If we look at real GDP per worker hour in information services, in finance and real estate, and in other professional services, we can see that there's a clear step change, after March 2020, where those areas basically see quite outsized gains in productivity. And I've got another graph to show you much the same. If we look at productivity per industry type relative to the fourth quarter 2019, we can see that generally in service industries that lend themselves very well for working from home and for automation, information technology, professional services, some financial activities, have really seen very outsized gains in productivity, right? So there is some evidence in what we're saying, in the sense that, yes, labor markets are tight, labor participation is low, but this basically is indicating to a labor market that is really upskilling and moving up the ramp in terms of productivity, right? So this sort of dovetails with some of those early comments that we were saying, that we don't want to talk about inflation again, but let's just shelve all the demand supply stuff for now, because that was covered ad nauseum last year. But if we just look at the labor market, if once the dust settles, it might not be the case that even with a very tight labor market, you necessarily get very heightened inflation prints. So that is a little bit about the labor market. I'll spend one more minute talking about financial conditions. You will remember in the beginning, I said that arguably this is the key driver, the delta in financial conditions this year. And what we can see, this is one particular very popular financial conditions index in the navy blue, the Goldman Sachs one, and we can see that financial conditions are on this downtrend downwards is effectively pointing to very accommodative financial conditions. An upsurge in this shows tightening, and a downward trend generally points to accommodative financial conditions. And what we can see is that even after the Fed had quite a dovish tilt late 2020, you see no material step change in financial conditions. So these are the kind of things, I won't go into all the details, but the typical constituents of financial conditions would be something like credit spreads, equity earnings, the yield on 10-year treasury bonds and the like, and movements in those kind of variables generally have some predictive power for GDP. But as yet, we've seen no material move in financial conditions, which has been a key underpinning driver of asset price appreciation since the financial crisis, really. So we're going to look out for changes in financial conditions, but as yet we have not seen any material changes, right? I'm going to stop there, and I'm going to hand over to Henk, and that is more or less sufficient as a general intro into the global sort of macro landscape. Thanks.
Awesome. Thank you, Reza. Fascinating short deep dive into what's arguably very important this year. I mean, trying to shy away from sort of headline media headlines around inflation, the Fed will hike, and that's an Armageddon scenario for emerging markets. In fact, we argue for the opposite, and I think the evidence is clearly pointing towards that. Yes, we heard from the Fed last night, and what's interesting from that statement is obviously the mentioning of the labor market, etc. And they will hike surely, but they're hiking for the right reasons, and that's actually generally positive for emerging markets. If we then go into the local context, very interestingly, similar story. So yes, the market expects the SARB to increase interest rates this year. So basically just showing you what that expectation is. So for the different months at the bottom, where the market expects 3-month rates to be. Interesting. So 12 hikes priced in 12 meetings if you take out sort of the outer years. But more importantly and more interestingly for us, and this kind of speaks to how we position across portfolios, in the sort of 5-month area where we see 3 more MPC meetings or opportunities for them to adjust the interest rate, the market expects them to increase the rate by 40 basis points at each of those meetings. That is strange. Yes, I agree with you. They do move in increments of 25, potentially 50. So how we get to that sort of numbers is up for debate. But certainly from our perspective, if we look at what's priced in, there's a lot of hikes priced into the South African context. There's a lot of hikes priced into the US context. And yes, the US might start moving, and we will start moving as well. We do hear from our MPC later today, but certainly from our perspective, we don't think we will see anywhere near these sort of levels in terms of interest rate increases in the South African nor in the global context. Looking at it a little bit differently. So what we do here in the sort of navy dark blue line is the 3-year rate, or the 3-year fixed swap rate, juxtaposed to the sort of teal color line, which is the 3-month rate that we looked at in the previous chart. And then in the sort of grayed out line, we have the spread, or the difference between the two. So for 10 years worth of data, you can see currently it's almost the most hikes, or at least interest rate increases, priced into the 3-year rate. And for us, there's really just a good indication that there's a lot of stuff priced in, a lot of bad news priced in, a lot of inflation reaction priced in, and certainly we don't think that there could be a lot more priced in. And in fact, we need to be very wrong here for us not to be taking some duration risk in portfolios. Okay, so let's dive closer to the portfolios and give you an update of where we are, how we performed end of last year. Certainly, as Darby said, we had a strong back end of last year across portfolios. Certainly from the income side, a very good 6 months. That saw us end up with a good number for the year. Just wanted to start off. This is the team. I mean, you get to hear from the two of us ad nauseum, but there's certainly a very strong team behind us. So this is the cash and income team, very established, very experienced, and really a great team to work with. So just a high level how we think about income again. It's important in the context like today, where we spend time with a lower heartbeat portfolio, and then obviously this sort of star flexible bond portfolio. But from an income perspective, we want to try and deliver a stable inflation beating return through time with a lower volatility signature. And we always say volatility is not risk, and that's absolutely the case. But certainly in a portfolio like this, where people are drawing regular income from, we don't want to see too many price movements in a portfolio like this. You want a sleep easy portfolio, low heartbeat portfolio. So how do we do that? How do we construct a portfolio to give you the inflation plus returns, but without that volatility signature that we do not necessarily want in these portfolios? So firstly, obviously, we try and maximize real yield, or yield in the portfolio. We have a big toolkit, things that we can asset allocate towards, so a lot of different income bearing assets, and we certainly will do that. And specifically, and we spoke about this a lot last year, we've seen the structural shift in the global context where real interest rates are fairly negative. So it does create a bit of a obstacle for us in generating real returns from the sort of more used sources. But certainly in the SA context, there's a lot of different drivers, and I'll show you some of them a bit later on. But certainly from last year, it was very evident that using the different drivers of real return can still see you get those inflation plus numbers at a lower volatility. When we do that, we obviously want to always control the amount of active risk, and I'll share a little bit later a deep dive into our risk budget and how we think about that, and how surgical we are when it comes to adding risk to a portfolio, but how much risk we can actually spend or afford to spend given the target and the sort of outcome that we're trying to achieve. From a credit perspective, I mean, we're not going to spend too much time on that today, but obviously that's a component of the income portfolios. We don't see a lot of value in the credit market at this point in time, just given where we see fixed rates, or at least the term structure, which Reza will take us through at the end. But certainly we do think that the value is rather in fixed rates and not in credit or floating rates. And for that reason, very light on credit, very light on term risk in these portfolios. But it's always important to understand that in a portfolio like the income provider portfolio. And then finally, it's all about structuring this portfolio to make sure we beat cash, but we're not taking on excess risk to get there. Okay, just from a return perspective, just gross and obviously A2 class. Apologies, I'm just going to mute the poll. Please don't do that. Please answer that. But yeah, some good numbers. As I said, we had a strong back end of last year. We're hitting our straps across the sort of different periods. Obviously, the CPI plus 3 sort of numbers come through quite strongly. Just do that again. Just wanted to give you a sense, so you can see from this, obviously this is the last 6 months, to give you a sense of how strong the back end of last year was for us. I'll show you where our returns came from, but just a sort of cross section of the peers, you can see fairly stable and just sort of outperforming over the last 6 months, which sort of got us to those numbers. In looking at the contribution of returns throughout last year, so this is every month for 2021 broken down to the different sort of asset classes that we used. You can see a big sort of subset of those. And they all positively contributed if we sum those. But more importantly, where we see some detractors in some months, we see the other guys dovetailing and helping us to get to sort of those positive numbers. Very sort of evidently here where duration was a little bit softer. Some of the other sort of offshore and pref exposures for us then kicks in. Nice little buildup of yield from the different asset classes, and just continuously compound those positive returns and positive yield contributors to get to the numbers that we want to get to. And then just for the quarter, so to keep it relevant for today's discussion, apologies. So these are the actual numbers for the different sort of exposures we had in the portfolio. You can see positive contributions for the quarter from most of them, most evidently from the duration position, some of the floating rate exposure we have, and then a very strong quarter on the preference share side, which I'll touch on a bit later. And then just the interesting chart again for us, just to, again, to hammer home this asset allocation, trying to find different drivers of real return and not just one driver. This is daily compounded returns for the Income Provider Fund relative to the Orbi. And you can see that's exactly the profile trying to achieve. Lower heartbeat, compound those consistent positive returns and get to the sort of same numbers that we try and achieve. Cool, that's just the cumulative. Obviously CPI +3 being the target. You can see since inception, obviously fairly strong, outperforming cash, outperforming the peers as well as inflation. Cool, so what are we currently still looking at? How are we getting to these numbers, and where do we see value in the market going forward? A very interesting one, and what we've seen happen more recently is on the offshore side. So you would remember or recall the way we think about offshore on the income fund specifically is by South African counterparty. So that would be South African government bonds and banks mainly in the offshore space, so where they have dollar debt. Well, buy the dollar return stream, hedge out the currency, so convert those dollars back into rands. We create interest rate pickup by doing that. And what we see from the forward as well as some of the dollar yields, we can compare the two assets from a local versus an offshore component or comparison. You can see there's a very nice healthy pickup for going offshore at this point in time. In fact, if you look at some of the spreads, they are pretty close to where they've been. So for us, a really good opportunity sort of taking off some of our rand exposure, certainly also some of our duration rand exposure, and rather taking that in the offshore space. The second one, duration, certainly going to be a core tenant in the portfolio again this year. We've actually throughout this month increased our duration slightly. We just see a lot of value there, and Reza will end off the session with exactly showing why we think so. There's certainly a lot of value still remaining in fixed rate in the South African context, and that will be certainly a key theme for us in the portfolio again this year. Then on the structured product side, this is also an interesting one, something that we are very good at. We understand it quite well. Obviously, the banks sit with a lot of bond risk. There's a lot of fixed yield in the market, and we can structure products with the bank where they pass on some of that yield to us, but they'll take some of the risk off and take it on their books. So we do this with the banks. We did a couple of these trades last year. They added quite a lot of nice yield to the portfolio without introducing that volatility that we don't want. Okay, and then on the preference share side, as I said, very interesting, sort of strong 6 months last year. Most prominently because of Nedbank coming to market and buying back their prefs. So that was sort of done at a 97.80 level. We saw most of the prefs re-rate on the back of that, so there's still some upside on the remaining bank prefs. Investec Bank also took their prefs out at 99.50 back end of last year. So interesting discussion around will the other banks also come to market. It's a wait and see, but certainly from our perspective, holding those prefs for the yield was a key theme. And that additional upside from those buybacks certainly helped the portfolio. And then finally, just on the inflation-linked bond side, obviously with a target of real return or inflation +3, if we can find assets that gives us that from an inflation-linked perspective, certainly that's something we'll look at. If you look at the front end of the inflation-linked curve, certainly if you look at some of the bank-issued ILBs in the front end, we don't need a lot of inflation this year for that to again outperform the cash markets. In this portfolio, we'll also group our renewable energy exposures that we can have in these portfolios. Certainly a great inflation plus income stream for us with a low heartbeat. So the inflation-linked assets is something we like. It's a core tenant, about 9% of the portfolio, and this gives us that nice inflation underpin that we do like in these portfolios. Well, then just a little deeper dive into how we think about duration and the income fund specifically, again, within the context of speaking about lower heartbeat and obviously the very good flexible bond portfolio. But from our perspective, how do we take bonds in an income fund? We want something that gives us obviously a strong total return. So that would be this block here. And then also the risk number is important. So 50% return, 50% risk. We kind of explain it in this way. So we want a sharp, efficient portfolio that maximizes total return with the added benefit of the diversification. So just to reiterate, maybe take a step back. So when we decide we want duration, which we certainly do think we want, and hopefully we've brought that case across today, how do we then take that exposure in the portfolio? So certainly from our perspective, government bonds, if we then decide government bonds, which bonds? And this is this process. It's very systematic. It's automated. It looks at total returns. It looks at sharp rates, etc. It's not a gut feel where we want to be on the curve. We let the numbers do the talking here. So what does that kick out currently? Just for some of you who would like a little bit more detail. So the current mix of bonds in our duration bucket within the income fund. So this is not on a portfolio level, but on the duration level. So these are the three bonds that we currently hold. The 186s, which is about a 5-year bond, the 2030s, and then the 2037s in that ratio. So just as an example, but really a lot of focus last year of making sure this process works. A lot of systematic data that goes into behind this. As I said, certainly not a gut feel of where we want to position, but evidence-based as how we want to position the duration component of our income portfolio. Cool, and then just onto preference shares. So this is just an example of how, or at least the evidence of how we saw those pref re-rates from a price perspective last year. So this is the yield relative to JIBAR. As we can see, that spread or excess spread has certainly come in based on those buybacks. A little bit more upside from the remaining bank prefs, which we still hold, but certainly a good trade for us. And we would expect to see prefs as an asset class probably fiddle out through the rest of this year. Cool. Now that we've looked at some of the things we actively asset allocating towards, or the active risk that we've exposed the portfolio to, let's just then look at the risk management side of things. So certainly from our perspective, the offshore component, as I said earlier, we're looking to increase there. That's certainly a risk for us. Yes, we do hedge the currency, so we don't see those currency movements, but certainly from our perspective, SA still being emerging markets, if we had to see some volatility in those bonds, we want some form of hedge there. So what we've done is buy some option exposure on the currency. So if the rand had to weaken, these trades will help the portfolio soften the blow and just create that asymmetry for us in return profile that we like in these portfolios. And since we last spoke, last time we had the webinar, we had protection against some of our duration. That expired in November. In the money was a good trade for us. It was our call back then to not roll that exposure, or at least roll that protection. We stick to that call. We do think the market is giving us sufficient value not to want to hedge at the current point in time with our duration position, and we'll keep it as is. Obviously, we always monitor this. If there's an opportunity to hedge and it's cost effective, we'll do that. But currently, in the current context, we're happy with the offshore protection and running the duration without protection. Then just a snapshot on then how we think about our risk budget and how much risk we can add into portfolios. It's always a question we get. So why not more duration or more prefs or more property? So this is really the answer. So what we do, and from our perspective, and you would know this quite well, the risk number we look at in the income providers portfolios to try and not lose money over any rolling 3-month period or rolling quarter. So that then would obviously mean that we have some form of risk budget, be it 3-month yield or 2-month return and yield, or 1-month return and 2 months yield, etc. So we'll look at all those scenarios. We'll take the most conservative one that currently kicks out about 2.24% of risk budget. Then how much risk do we have in the portfolio? So we'll break it down into the different credit exposures. So be it bank senior, additional tier 1 bank bonds, tier 2, which would be subordinated bucket bonds, corporate bonds, SOEs, inflation-linked real duration, nominal duration, preference shares, property. We'll look at what we have in the portfolio from an exposure perspective. We'll shock it. So here we have time series and data going back. We'll take out the worst 1% move. We'll take a 99% level confidence level here. We'll shock these positions for the shock that we've seen. This will create a basis point impact on the fund level. And that then obviously adds up to get to our current risk number. So we're always actively looking at this, trying to make sure we're always managing the active risk in the portfolio as to not jeopardize that risk target that we do have in this income provider portfolio. Cool. Then just in summary then, focus again this year, obviously real returns. We do think we have the ability to get there again, lots of yield. If you look at the yield this time last year, certainly more yield in the portfolio. We do think inflation is probably peaking soon. So from a real yield perspective, opportunity again, certainly from a cash perspective, we do think income is a better opportunity set. I've shown you how we're going to manage the capital risk in the portfolio. It's a lot of focus on that. We're very surgical when it comes to that. On the credit side, still very little value for us. Some fixed rate exposure here and there, but certainly from our perspective, we like the government bond exposure. We like some of the fixed money market exposures, and just finding those structured opportunities, and some opportunity in the offshore space. Okay. So just in summary, we'll obviously share the slide pack. This is the asset allocation as at the end of December. As I said, we've increased this slightly. Current running yield is a little bit more than 7, but I think a fund yield of 7, if nothing happens, that's a good outcome. Perfect. That's more or less my time. I'm going to hand back over to Reza, take you through the flexible bond fund, and really hammer home this idea that we do think that still duration is a great place to be.
Yeah, and thanks very much to Henk again. Yeah, and I mean, just tying it up with those couple of slides you saw in the beginning, if the conclusion was still somewhat up in the air, what we're just trying to say before I get into the fact in 30 seconds is that bonds take their cue from global factors. The chief most amongst those global factors this year will be the change in financial conditions as brought about by the Fed. Will financial conditions change? Yes, they will. Will it change to a magnitude that essentially erases almost the case that I'm going to make now? We don't think so. On early evidence, it does not seem that way. In other words, the case for risk will remain largely intact, as we've been making, for the past 18 months. And just anecdotally, you saw some correspondence from Jerome Powell last night, effectively cementing and effectively confirming that there will be sort of a March hike. Even with that information, bonds opened up stronger this morning. Which speaks to exactly the point we have been making. So looking at the flexible bond fund, just diving straight now into this. So the team consists of 3 members. So it's a team that I head up, and I've got Vishal and Ruan, both relatively new, but the experience, sort of belies their quite excellent capability with regards to the quantitative bond modeling side of things, and they've churned out some excellent work for me and the team for the few months that they've actually been in the bond team. So that's the team. Right, and into performance. So yeah, was quite a good performance here, for 2021, the calendar year. So we can see we registered a return of 14.5% at a time that the Orbi does 8.4. But just in terms of the way we think about this portfolio is that we don't simply benchmark ourselves to the Orbi, because we think that it's a little bit, in a manner of speaking, a little bit too easy of a benchmark to beat. So what we do is we try to outperform the term structure. In other words, we try to say, if you look at a rolling period of 3 years, what has been the best asset class in terms of typical yield assets, like you see on the left-hand side here, what has been the best of the term structure, and flexible bonds aims to outperform that. So what if I could show you, if we just look at the past 10 years, for example, flexible bonds does 9% annualized, Orbi does sort of 8.2, and the Steffian inflation, coming up for lower figures. But what this means is that it typically outperforms all the other asset classes, and therefore any other combination of these asset classes, which is exactly what it says on the can for flexible bonds. So in the past year, actually inflation-linked bonds had a very good December, a return of over 5% for December alone. But as you can see, the general shape here is that flexible bonds, offers you the best of the yield curve. So we asset allocate to give you that best of type of signature, right? This cumulative graph effectively shows the same picture, the navy blue line outperforming in cumulative terms any of the other lines that you see, the Orbi, inflation linkers, cash, or inflation, telling the same story, right? Okay, so diving into some of the reasons that help us to build such a high conviction and strong case for SA bonds, and I will never miss an opportunity to talk to the slide. I spoke to it in the last webinar as well. But what it really shows you is that, in simple terms, the South African yield curve, certainly the back end, has been priced for default. What does that really mean? If we look at a 10-year bond, compared to a 10-year swap, we will see that from the period, and I've started here in 2013, going up to the period just before Nenegate, you will see that a 10-year bond more or less moves indistinguishably from sort of like a 10-year swap. They are essentially the same line. Come Nenegate, you have a different story, and you see a clear bifurcation here. In other words, you see a clear parting of the ways here between nominal bonds and the swap. Now why do you have this phenomenon? You have this phenomenon because, technically speaking, your swap curve is supposed to sit above your sovereign bond curve, because the swap curve embeds bank risk, whereas your 10-year sovereign bond is supposed to be like your risk-free treasury curve. However, we see the inverse of that picture in South Africa, which means that there's something else going on. What is that something else? Well, essentially, for those that know the mechanics here, they will know that you don't actually outlay any money in a swap. You don't put any money on the table at the outset of a swap. So in other words, you can't actually lose any principal in the swap. It's based on a notional principal, and you exchange interest payments every quarter. You can lose your capital in a bond. And therefore, if the supposed risk-free treasury curve sits above the swap curve, it is saying that the market is telling you that I think I'm not going to get my capital back, right? I think that there's a material risk of default that's been priced into the South African bond curve. Now, to the extent that you think that this is a real risk, this is a genuine risk, then you should flee away from bonds. However, it's not our contention, and it's our strong view that there's no real risk that you will lose coupon payments and principal on a bond, and therefore you should exploit this kind of differential by taking a long position in South African bonds. Okay, so this essentially this idea of being priced for default finds expression in a graph like this, which essentially shows you you've got South Africa here on the far most left side, and with its most commonly compared emerging market cohort going down the x-axis. What this shows you is the level of term premium that is embedded in the various 10-year bonds of all of these sovereigns. So coming back to Davi's question in the beginning, is that this dot effectively shows you the compensation that you get in these localities for taking duration risk, right? It's the lockup premium that investors demand for taking risk. Now, in South Africa, in this case over here, it's far and away higher than anything else that you can get in the emerging market space, and it's far and away above its long-term median, meaning that term premium is very high. The compensation that you get for taking duration risk is extremely high. It almost looks like a statistical outlier. But the reason that you have this phenomenon is because the front end of the curve remains somewhat anchored. You haven't seen that many hikes, but the back end of the curve is still very elevated because of high term premium. And just to almost like paint the story in a different way, the navy blue line here shows the average term premium for emerging market high yield sovereigns. In other words, you've got real basket cases in here, like the likes of Turkey and the like of Argentina and the likes of the Poland and some Eastern European high yield destinations there. But even for those countries, you see term premium averaging around 200 basis points or 2%. Whereas South Africa is giving you more than double of that, right? You get more than 4% of term premium. So it really is the risk premium with regards to term premium here is a really fat bundle of risk, that a fat bundle of premium that should be harvested for those that can take on duration risk. Okay. To tell the story in another way, even if we look at our 10-year nominal bond yields and we convert that into a dollar yield by essentially hedging out the South African rand risk from local currency bonds, we still come out top of class, right? So some foreigners like our bonds, but they don't like the rand risk. That's fine. If you want to hedge out the rand risk with a forward, you still come out at something between 4 and 5% in USD terms, at a time when the actual USD 10-year bond is sitting at below 2%. So even if you want to take out the currency risk, we still come out, at top of the class compared to any other emerging market destination, right? And just building on this, I mean, effectively, if we look at the yield curve, the African yield curve as it found expression in 2016, we found that this is not a graphical error. I mean, this is exactly how the yield curve looked in 2016, where you were almost equi-compensated. Doesn't matter where you were on the yield curve in 2016, you sort of could get around 8%, whether you were in a 208 bond in 2023 or back at the long end. The story very materially different, and the yield curve is actually very steep, and that's why it makes it look like the gold line is actually a horizontal line. But it actually shows you that, in fact, all the value, and speaking to my term premium point, all the value really sitting at the long end. Why? Because the curve's been priced priced for default, whilst the front end, is somewhat captive to monetary policy. We had 300 basis points of easing in 2020, and that's why you see a very sort of pedestrian-ish kind of front end and a very, very elevated long end. So for those that can espouse some duration risk, there are certainly a lot of merits to do so. Will it be a bumpy ride? Absolutely, it will. Will you have a higher heartbeat? Absolutely, it will. So it's not that much of a sleep easy portfolio, but if you prepare to see through the peaks and troughs, there's a lot of value that is sitting in the back end of the African yield curve, right? Got about 5 minutes before I need to wrap up. Effectively, this is just slicing and dicing the cake up in a different way. There's a typical way in which you have a South African 10-year bond yield decomposition, where you build it up from component parts, a US 10-year base level, something that approximates sovereign risk. So I typically use the CDS premier over here. And then you have something which approximates your currency risk that you've taken. These are all local currency bonds. And what we can see, South Africa sitting there, 9.9%, effectively embedding a 5.3% currency risk premium. So remember, your currency risk is effectively a differential, right? Currency risk relates to inflation differential. So let's just say over 10 years, the US gets back to 2% inflation. For this to be a differential, it really means the South African inflation on what the market is saying needs to trade at 7.3% on average for the next 10 years in order for that 7.3 less 2% in the US to get to 5.3. So that's a very punitive assessment that the market is saying. It's saying that you're going to get an extreme amount of inflation, extreme amount of currency depreciation in South Africa, and we don't agree with any of those contentions. We're still getting to the point in another way. We still believe that there's a lot of fat that can be harvested from South African long bond yields. So just another way to tell that story, right? This really speaks to the point. I've got about 4 minutes left, and just to almost like reiterate why we can have this kind of degree of conviction that you won't have an outright default on local currency bonds, simply because South Africa, and this is one of our saving graces when it comes to rating agency profiles of us, is that we've got an extremely well-developed and deep financial sector. It dwarfs the sophistication of the African financial sector, dwarfs anything else in the other emerging markets. So local pension funds are invested 24% in our local currency bonds, insurers 7%, and banks around 20% of local currency bonds. So it really means that if you really have a hard default on local currency bonds, it would effectively obliterate the financial sector as we know it. I mean, for banks alone, they'll leave it, many, many times, 10, 11, 12 times. So it just takes more or less like a 10% hit on assets for them to wipe, for the equity to get wiped out. And certainly one of the quickest ways you could do that is if you defaulted on your local currency bond. So obviously the powers that be would pull many, many other levers before, it agrees almost to a local currency default, which would effectively wipe away the bank, pension fund, and insurance sector. So we believe that it's not a genuine prospect that we have a default here. It's always a popular question, right? Yes, they can print money. Yes, they can monetize the debt. That will have inflationary consequences, but your capital as such is not at risk. Okay. This is just a kind of decomposition to give you an idea of when we look at yields, we don't just look at the top number, is 9.4% high or low. We have this disaggregation here of the 9.4% into a term premium and an average expected short-term rates component, and those we can decompose even further. I won't go into the technicalities, but suffice it to say that we look at all of these building block components, and we've got time series data for all of these components, so we can understand exactly if this 9.4% is high, why is it high? We can understand which component is giving rise to that being high. For us, spoiler alert, as I mentioned in the beginning, that's because this term premium is so very high, dwarfing anything else in the emerging market space. Term premium is very high because default's been priced into the yield curve. So in summary then, and I think finishing very good for time, we have an extremely steep yield curve. I think that I've made that point several times. You need to exploit the long end if you want to outperform the ALBI, and if you want to secure high real yields going forward. Yes, it will be a slightly bumpy ride from time to time, but the way to really get solid real yields over the term of your investment, if it is sort of 20, 30 years, is to exploit the long end of the curve, right? Globally, as I said, just rounding it all off again, as I said, a central theme will be that of tightening financial conditions. We don't doubt that there will be some tightening, but it's our contention that financial conditions will not tighten to a magnitude that will derail the case for risk assets. I mean, if that does change, if we do monitor in our systematic data-orientated fashion, if we do monitor financial conditions changing abruptly, it's not our base case, but if that does happen, we will change tack. But at the moment, financial conditions still very accommodative, right? In the US, the story about how inflation and tight labor markets suggest an economy that is in dire need of monetary intervention, and that will come as early as March. But we don't actually find evidence, and I mentioned that in the beginning, that there's been this massive unhinging or de-anchoring of long-term inflationary expectations. And as I said in the beginning, forgetting all the stuff about heightened demand and the slow supply side, if we move to and look just at the labor market, which is the usual starting point to take cues for inflation, the labor market has changed in meaningful ways. US is moving to a very productive labor market, and even for very low unemployment, you might not see that much exaggerated inflation, right? So long end yields still represent a very attractive proposition, in a context where global financial conditions are still in expansionary territory. I think that is exactly 10:50. So I will stop there, and we will leave 10 minutes or so for questions or so. The slide pack will be made available to you. If we just look at portfolio positioning, I'll just minimize that. We can see the T line representing the Orbi duration. We can see we are comfortably ahead of that based on exactly what I've said. Aggressive active duration stance above that with regards to our nominal exposure, and we still have some linkers in the portfolio, remembering it did close to 20% last year. That was inflation-linked bonds, and so a very active duration stance, a very aggressive, if you will, kind of stance, but one which we think we've got high conviction, and one which was proved to be absolutely right over the course of 2021, right? That's more or less what it looks like. So got about 7.8 years of nominal duration, about 1.5 years of real duration, and the running yield of the fund about 10.6% at a time when Orbi duration is about 6.3 and the running yield about 9.6. There's the composition, a very sovereign heavy portfolio based on exactly the kind of arguments I've been making all along. So I'll pause there, and myself and Henk are happy to take any questions from the audience.
Just maybe one final comment to nail all of this home, or bring it home in a nice contextual way. Flexible bond yield of 10.5. If we speak it to you guys this time next year, and the back end of the bond curve compressed by 50 basis points, only 0.5%, which I mean in all terms is very, very small compression. Your total return is in excess of 15%, and just really speaks to that value that we do see in that back end. Just to give you a number to think about, when you see a lot of numbers, but that's 15% total return for a very small compression in the back end, certainly for us stands out. Cool.
Cool. Thank you, Henk and Reza. Reza, yeah, there's quite a couple of questions. I think most of them actually aimed at you, but let's start here. At the beginning, you talked about the US labor market and the mismatched.
Yes.
Could that perhaps be because of the lack of financial incentives to apply for work?
No, it's not that at all. It's essentially, if it were the case that you have all these jobs available, right, and you have all these people actively looking for work, then you would see that coming through in the unemployment numbers, because unemployment measures the proportion of the labor force of people actively seeking work, but not able to find it. Now, that's not the case because unemployment is low. So you have people that are almost discouraged from applying. They don't want to apply anymore simply because they believe that they don't meet the skill set required by the new job specs. And what are the new job specs? The new kind of job specs of the jobs that are available are productivity heavy jobs. So now that previously there was an advertisement for a shelf packer, that's fine. But now the advertisement says, I want a shelf packer, but I also want this person to have skills in managing the online inventory system for online shoppers. It's a different skill set now. So now you have the guy, he would have applied for the shelf packer role, but he's now discouraged from applying because he knows that he doesn't necessarily maybe have the IT skills to sort of fit into what the shop now requires. And all of this is again indicating, so it's not lack of financial incentives, because for those that actually do get the jobs, they are paid very well, because we see that coming through in wage growth. But it's just that you have this big block of people that are simply not applying for jobs. They've been discouraged simply because the kinds of jobs that are now on offer are productivity heavy jobs. You know, there's no way back after COVID. I mean, like, this is the example. I've always, it becomes the running joke here inside Prescient, but I always quote this example. But I mean, if you walk into a McDonald's, for example, I mean, like, when's the last time you were actually served by a cashier? You don't have that anymore. You go to a touch screen and you've got to order there with a little touch screen and whatever. So the migration towards higher productivity and less people doing non-productive jobs is something that is a step change, and there's no way back. There's no way back from that.
Cool, thanks. While we with you, can you just quickly clarify the benchmark for the flexible bond fund? It's sort of got a dual benchmark going.
Yeah, so formally the benchmark is still the Albee, right? I mean, if you look on the fact sheet, it is still the Albee. But what we think is, what we're trying to say here, I don't want to scroll all the way back in the slides, but what we're trying to say here is that let's look at an example where the Albee does 4% and cash does 7%. And your portfolio, the flexible bond portfolio, let's say does 5%. Now you've outperformed the Albee by 1%, but you suffered a 2% opportunity cost because you didn't beat cash, right? So the idea is that at all times we're trying to give the investor the best of the yield curve. So I want to be more than cash, I want to be more than bonds, I want to be more than inflation. That's the idea. So Albee alone would be a little bit too easy. A benchmark, we want to give ourselves a little bit of a higher hurdle. So formally, fact sheet wise, it's still the Albee, but you know, the way we manage it internally, we try to give investors the best of the yield curve over rolling 3-year periods.
Cool. Henk, well, actually, for both of you, Henk, you touched on duration on flexible bonds now at the end. In a minute, quickly, can you and Reza sum up the duration of both income provider and flexible bonds, and what the risks are if you get the duration call wrong?
Perfect. I'll go first, 100%. So obviously, from our perspective on the income side, we have a number of different levers we want to pull to get to our real return. That's the one component of how we think about things. The second component is the risk component. So we don't want to lose money over any rolling 3-month period. We calculate that quite exactly. So that will then inform us how much duration risk we can take. We definitely want duration risk. There's no question. Just how much is the question. So currently in the portfolio, about 1.4 years of duration is the number that our risk budget kicks out, and that's where we are. So yes, that's where we want to be. That's what it speaks to on the can. That's what the portfolio tries to give you. It's always risk measured when it comes to duration, but certainly the question about wanting duration is yes. The question of how much is where it's a little bit different.
Reza?
So from my side, so the portfolio has got a significant amount of active duration. Okay, so let's just call it sort of like if the Albee duration is about 6.3 years, you're looking at sort of a flexible bond active duration of about 3 years active, or duration of about 9.3 years. Let's just say. So what does that mean? It means that if yields in parallel were to sell off, right? In other words, the yield curve shifts upwards 100 basis points. It means that I would underperform the Albee by 3%. Okay, I would underperform the Albee. But so you would have that element of relative risk of underperforming the Albee, right? But I want to also say that it's not so much a case that there's so much absolute risk in the portfolio, in the sense that it's a popular conception that you would almost break the buck. In other words, you almost get a negative return over a 1-year basis if yields sell off. Now, that's actually not true. I mean, and we can show that long end bonds, because of the high coupon cash flow yields that they actually offer, yes, you take a knock on the duration effect, but actually your coupon cash flow yield means that you can still end the year in the black, even for your bear case. Even if your bear case actually materializes, you don't get a return below 0. So yes, you will underperform in relative risk, and you'll underperform the Albee if our call gets wrong, but you won't go below 0 because of the high carry that's on offer in long dated bonds.
Yeah. And just to again, to put it in numbers, so 186s being a short bond, and we're not talking really about the short bonds. If that 186s was this time next year 1.5% higher from a yield perspective, you would have still performed the same as cash.
Thanks. Perhaps two last questions. I think time is almost up. With the forward rate market pricing in such aggressive rate hikes, is it related to how the SA banks price these instruments? And then the commenter sort of made, sorry, that's I cannot believe the SA economy can withstand 3% rate hikes.
Yeah, so I think the forward rate market is where the market is pricing these instruments. So not really what the banks, yes, the banks are on the other side of those, but they will hedge their risk out. If you look at what the bank consensus is for where rates should, or where they think rates will be at the end of the FRA curve or at the end of the forward rate period, it's about 1% lower than what the market is pricing. So certainly we also agree that we think that what the market is pricing is a little bit too aggressive in terms of rate increases. Yes, there will be, and most likely we'll see one today, but I mean, to the point, can we sustain 3% of rate hikes in the next 2 years? Most likely not. Do we try and predict where rates go? Also not. Or do we look at what's priced in? Certainly we do, and we look at where the value is and how much we can make from that. And certainly what that does tell us that we want some fixed rate exposure, and the rate hiking cycle is potentially too aggressive.
Cool. One last question. We all know that SA bonds are cheap now, but what will be the catalyst for that value being realized? Reza?
Cool. Yeah. Quite a nice, easy answer. And that one is that, I mean, effectively, even with the yield curve doing as well as it did, the back end returning, over 12% for 2021. Remember, that was achieved largely with a complete absence of foreigners from the weekly auctions. So if you exclude the sort of like maybe December and early parts of this year, for the year in total, you had massive amounts of offloading of South African bonds by foreigners, and we believe that there was a general sense of uncertainty and there was a general sense of becoming captive to news flow and headlines, as distinguished from the actual merits of the investment. So to put it to you simply, foreigners will need to take up, a much bigger presence in the weekly auction, something akin to what they had in the years previous sort of like 2019 and before that, something and become almost the new price setters, the guys that are sitting flush with nominal bonds, or asset management firms and pension funds and the banks, right? But all South African domicile. So foreigners need to come back in mass. We believe that they do come back in small drips and drabs as soon as the risk on dial turns favorable. And we think that if the Fed actually hikes to an extent that has already been factored into expectations, it will simply be somewhat of a non-event, and sort of those risk on impulses will return to the market, despite what you may read in the Financial Times and other popular news flow journals. But so foreigners coming back can be a major catalyst for our bond market.
Cool. I think that's about what we have time for today. Henk, Reza, thank you very much. Thank you very much, everyone, for joining us. And please remember to join us on the 14th China update with Liang and Tian from Shanghai in China. Have a great week and all the best for the year.
Thank you, everyone.
Thank you.